Greetings, everyone. This is Cathie Wood, CEO and CIO of ARK Invest. Well, we had a little reprieve from mid-June to mid-August in terms of the equity markets, at least, and now we're having a test of that rally. So we'll talk a little bit about that. We do think we're in a bottoming process. I know it's frustrating, and I've been in many of these markets. These are bear markets. Anything down more than 20% is a bear market. And at the turning points, it just seems so frustrating. But stick with me as I'm going through the usual drill here, and I want to give you a sense of why we think we're bottoming, and what the tug of war is out there, and how the evidence is piling up that we are probably moving into a deflationary environment. We're getting real numbers now. This is not just a hypothesis. So stick with me, and we'll go through fiscal policy, monetary policy, economic indicators, market indicators, innovation, and on deflation associated with innovation. So in my career, during most difficult times in the market, recession times, I know there's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession, and I think the evidence is accumulating that the statistics that we're getting fed day to day, and to which the market reacts so violently, may be very distorted by seasonal factors. And I'll get into that in a moment. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. And instead, what we're getting now is the opposite: fiscal policy tightening, including the Inflation Reduction Act, and monetary policy tightening, and tightening aggressively. So fiscal policy. We got the Inflation Reduction Act, and as I think many studies have corroborated, the initial University of Pennsylvania analysis was that it would not reduce inflation per se. And yet we probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up. Now, this is over a 10-year period by $737 billion, and spending will go up by $437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag, and is contributing to the recession we believe we're in. On monetary policy, so Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. And we read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice. But he also hinted by using the phrase keep at it or keeping at it twice. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. And as we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then, of course, in 2020, we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system and certainly to housing. We're seeing statistics, and I'll go into them in a moment, all over the place, that housing is in a recession. And I do believe we're seeing evidence that prices are going to follow. So we're concerned that the Fed's overdoing it, and that in invoking Volcker's name twice outright and then indirectly twice that Chairman Powell was basically going to say, we're keeping at it, and we almost don't care what happens to the economy. And in the statement, it was very interesting. There was no focus on real economic activity. The only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation. Now, the reason this is so important from an investor's point of view is if you look at valuation, so PE ratios in the 70s and early 80s, I think they bottomed out somewhere between the 6 and 7 times range. So 6 or 7 times earnings. And I believe that was in 1982. And that was because inflation had been ingrained and the discount rates, I mean, we were at a double-digit interest rate, so valuations should have been that low. Now, many people believe, and certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market. Because today the PE ratio of the S&P 500, assuming $200 for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate, the S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s is wrong. And I think a lot of price indicators are beginning to corroborate that. The reason we worry about the Fed making a mistake is it seems to be focused on lagging indicators. Now, employment is one, but I think in the Jackson Hole speech that basically Chairman Powell said he didn't really care what happened to the real economy, and that would be employment. But the PCE deflator, so the PCE deflator that the Fed uses is the core PCE deflator, taking out food and energy, which are sometimes held hostage to supply shocks, like we have seen. And I'll get into where that metric is, but it peaked in, I believe, February, and has been coming down little by little since then. We'll get into that. But it is a lagging indicator. And we're down to 4.6, just to get to that punchline. And I think if we've just started to see declining prices hit the PCE deflator. It won't be long until we get to 2% if we're right about the massive inventory overhang, not only in the United States, but around the world, and the kind of price cutting that will take place to clear shelves and clear pipelines. We're also seeing a lot of commodity prices already reflecting either that expectation or that reality. So we wish the Fed would focus on some of these leading indicators of inflation, because by jacking up interest rates from here, they're going to make this recession worse. But we also believe that these declines in commodity prices are going to get into the broader-based price indicators closer to the consumer, and that if that happens and the broad-based price cutting becomes headline news, the Fed probably won't need to see the whites of the eyes of 2% inflation. Now, M2 itself, it peaked at 27% at some point in 2020, and it's down to 5.3% as of July. And given what we know about demand deposits in the banking system, it's probably going to drop to 4% in August, not leaving a lot of room for both growth and inflation to coexist. More important to us is what has happened to money supply in the last few months. It has been flat. It peaked in March, and basically it's at March's level today. That rarely happens with money supply. And so the longer it stays flat, the lower the year-over-year growth rate will go, 4.1%, 3%, and so forth, and could get to zero by the end of the year. And so we're watching that carefully. And we are, of course, wondering what the Fed's next move is. They say they're going to jack interest rates up again. And we'll talk about the employment report in a minute. But there is some fraying at the edges inside employment. And I think there's also perhaps a big seasonal factor distortion. You know, as I've watched initial unemployment insurance claims come in the last few weeks, at the same time, we're seeing one headline after another of layoffs. I'm saying this disconnect doesn't make sense. The real world is not consistent with these statistics. And it just dawned on me. I know some people have been talking about seasonal factors, but in watching what has happened to claims, I do believe this may be an issue. So let me go into that. Will the Fed raise by 50 or 75 basis points? I don't know. I think if we continue to see prices fall, meaning commodity prices, and we'll go through some of them in a minute, they may go the 50, not the 75, just to signal to the markets they're perhaps not as hawkish as Chairman Powell suggested in his Jackson Hole speech. Now, when I say seasonal factors, the reason they might be messing all of our statistics up are economic statistics around which, you know, markets move in and have become very volatile. Maybe these things are wrong. Now, why would that be? Well, there's something called Census X13. I think we're on 13 now. It's a seasonal factor methodology. So trying to correct for typical seasonal patterns. So just to give you an example of that, you know, a lot of teachers are not teaching during the summer, and the seasonal factors expect that. So in the raw numbers, you'll see a big decline in the number of teachers out there. And it usually is pretty consistent year to year. And so the seasonal factors adjust for that. And if it's typical, normal, it will basically see a flat teachers employment. The problem with this Census X13 methodology, and I worked with Census X11 in the day, and I think they're very similar now, is the previous 2 years get the biggest weighting. Now, I know that they have tried to correct for some of the some of the COVID distortions, but it appears to me that there may be some residual or lingering COVID impact on today's numbers. So expecting very weak numbers, as we saw during the last 2 years, and basically adjusting for that and making the economy actually look stronger than it really is. Now, I'm saying that after we've had 2 consecutive quarters of negative real GDP growth. What if the seasonal adjustment to the GDP numbers was wrong and was expecting a lot of weakness and adjusted it out? That tells us that in the real world, maybe things are worse than those numbers have suggested. So I'd like to go into the employment report a little bit now. And I have no idea how the seasonal factors have messed these things up. So we'll just work with what we have. So the household, non-farm and payroll employment was roughly in line with consensus expectations, up 315,000. Household employment was up more than 400,000. Now, we pay more attention actually to the household. And if you look at household employment, it flattened out and actually went down from March until this month. And so from March through August, effectively, it's been flat with this latest 400,000 booster. But if you look inside the 440,000, what you're going to find is that's all part-time, much lower paying jobs. Full-time employment is down. And so that's a problem for the economy. It suggests stresses and strains, more people having to work 2 jobs to make ends meet and pay for food and energy. So that's a problem. And what's also interesting is if you look at the gap between the non-farm payroll employment number that seems to have been, charging ahead, and the household employment number that's gone flat, that's 1.6 million people right there. So there's a huge discrepancy between those 2 measures of employment. And the household employment measure includes many more small businesses, and they often react much more quickly to changes in the economy than do large corporations, which are captured more by non-farm payroll. But some cracks in this report, seasonal factors aside. The unemployment rate did go up from 3.5 to 3.7%. We did have an increase in the participation rate in the labor force, so that's maybe it certainly is one reason for it. The average hourly earnings were up 0.3%. And we now know that they peaked on a year-over-year basis at 5.6% in March. March is an important month here. It seems like a lot of things peaked back then. And now we're down to 5.2%. And still, that's a huge loss of purchasing power because inflation during this time was up, if you look at the CPI, which does include food and energy, up 8.5%. So, more than a 3% loss of purchasing power on a year-over-year basis. The other thing we saw was the average work week ticked down. Most people do not pay attention to this number. It just changes by 1/10 or 2 per month, up or down. But it often has an outsized impact on average weekly earnings. So those are even worse because hours have ticked down. The other thing to note is that the Challenger survey, which measures layoffs, broad-based layoffs, those are up 30% year over year. This is what I mean. We're seeing all of these headlines, and the Challenger survey suggests they are real, and yet we're not seeing it in the employment report. Initial claims, as I mentioned, having spiked at the most rapid rate going into a recession that we had seen, now seem to be settling down. And that's got me wondering about this seasonal factor issue. The other employment-related number that came out this week was JOLTS, job openings. And they went up. They went up. So the skill set mismatch, or companies not paying enough to attract labor, is still impacting the job openings, the number of openings. I think steady state, they used to be 2 to 3 million, and now we're up to more than 11 million. In terms of other economic indicators, retail sales in the latest month and personal consumption expenditures, both flat, and this is in real terms. And auto sales, and I pay a lot of attention to auto sales. It's a big ticket item. And then at a steady state, they're usually 17.5 million units at an annualized rate here in the United States. So we know because of chip shortages that they were very depressed for a long time. So one would have thought pent-up demand was increasing. Well, chip availability clearly is easing, and yet auto sales dropped from 13.3. Remember, I said steady state is 17.5, and we haven't been there in a long time. They dropped slightly to 13.2, and they probably moved up more because of electric vehicles, certainly more because electric vehicles are booming, and traditional gas-powered cars sales are floundering. So this is a big problem for the auto manufacturers. They're 90 to 95% of their sales are still gas-powered. And so it was curious for us to see GM reinstate its dividend. I think that was Mary Barra's way of showing confidence that they'll be able to transition into the electric vehicle age pretty well. But, I don't know. This is a very big shift. Housing is in some ways in free fall. There's a lot of negative sentiment. Housing starts dropped roughly 10% last month. Permits down 1.3. The National Association of Home Builders haven't been this negative since the 08-09 period. So existing home sales down 6% in July, new home sales down nearly 13%. And that's month to month. If you were to annualize that, you'd get a sense of almost free fall in the housing market. That's what, close to 6% mortgage rates will do. And it's happening. So, and housing has a very big multiplier out there. A lot of other industries are dependent on it. So we don't take it lightly. Consumer sentiment did bounce a bit, and boy, the markets ran with that. But the bounce was related to gasoline prices coming down, which is great. But it got us to the low points, basically, that we hit in 08-09. So in other words, we were at record lows. It got us back to the low points hit in 08-09 and in 1980-81, when inflation and interest rates were in the double digits. And Chairman Volcker was being very tough from a monetary policy point of view. We also know that the consumer saving rate has dropped to 5%. Now, it was in I can't remember the exact number, but I think in the spike it went to somewhere in 20% when no one could spend any money during the early days of COVID. Now we're down to 5%. And we haven't been that low since, I believe, 2009-10. So a lot of people are using this, hey, because of all the stimulus out there during COVID, there's still $3 trillion worth of a buffer. You can make that same statement when you're talking about consumer net worth. Consumer net worth is $130 trillion. What that means is assets, so stocks, bonds, houses, and other longer-lived durables, like cars, minus liabilities, how much we owe. And that's 130 trillion. And that's been going up regularly. It gets knocked during recessions. It's being knocked a bit right now. But that's a huge buffer too. So I think that, and that narrative seems to be making the rounds and fueling this idea that the consumer is going to continue to spend. Well, if you look at good spending, the consumer, in real terms, the consumption of goods is down and has been falling for the past year. And it's still above the trend that was in place pre-COVID. And the inventories are massive. Nancy Lazar at Piper does a seasonal adjustment of company inventories. And if you look at Walmart, again, one of the best managed companies in the world, its inventories in the July quarter did not go down. They did not go down. And we had already said, oh my gosh, they're swimming in inventories. So I think they're going to have to start slashing prices to get the consumer to bite. Okay, on to inflation as part of the economic indicators. Got a lot of reinforcement, the Fed did, from the headline numbers, which again may be distorted one way or the other. PCE deflator, which the Fed pays most attention to this, down 0.1% month to month in July. So that's deflation. The core rate, which they pay more attention to, again, taking out food and energy, as I mentioned before, was up 0.1% and has dropped from 5.3% in March to 4.6%. Again, they are looking at 2% vis-a-vis that number, so 4.6% to 2%. We believe, based on the early indicators of inflation, that we're probably going to fall close to 3%, could be below, by the end of this year, early next year. So the fact that we will have gone down from 5.3 to 3-ish%, I think will mean something to the Fed. Again, the commodity prices, the pipeline says deflation is the order of the day. So let's go on to markets now. As I mentioned earlier, we had a nice rally. Some were calling it a bear market rally. 23%, I think, on the S&P 500 from mid-June to mid-August. And now we're giving back. We thought one of the reasons for that rally was that the Fed was going to pivot and that the market, seeing the deflation in the pipeline, assumed that the Fed would start talking about that deflation. Instead, we got Jackson Hole, and now the market's relapsing. We do think we're in a bottoming phase here because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish, wants everyone to believe that they're going to be as tough as Volcker was in order to get to 2% faster than would otherwise be the case. You know, it could be a lot less than 3% if some of these big retailers start slashing, they need to, prices in order to clear the shelves and put in holiday merchandise. So we'll see in the next few months. As to markets now, so starting with equities, we've talked a little bit about that. As usual, equities are very dependent on a couple of things: profits and valuations. Now, we think profits are going to be hit hard here. More the cyclical part of the world. Our strategies are not biased cyclically. If anything, they're biased completely in the opposite direction. And they tend to do well when overall profit margins are coming down. Now, profits in the GDP accounts looked like the early indications were that they were down significantly quarter to quarter in the second quarter. It seems as though they moved up to an all-time high. What I have found with these metrics around turning points, these metrics and especially employment is the revisions. If we're really in recession, the revisions are extreme. If you listen to all of the companies reporting, you would not believe that profits are up. Many of them are down and down in a very big way. So again, this dependence on economic indicators, which may be distorted by seasonal factors gone wild during COVID and an inability to adjust them accordingly, could be distorting some of these numbers. The second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think, but the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out. I think watching prices, real-time indicators, supply relative demand is going to get us to the right answer faster. And right now, we'll go into it in a minute, those indicators are showing in some cases signs of collapse. So the interesting thing, and we are keeping in fixed income, we are keeping our eye on the 10-year. It peaked at 350 in mid-June, just about the time the stock market bottomed, and got down to 250. We went down 100 basis points by early August. We're back at 320 today, again, because of the Fed's hawkishness. So, the short rates moving up and long rates kind of following, not quite as quickly. The yield curve still negative, not as negative as it was, but still negative, and that's important. So we believe longer term, if we're right on our deflation call, that we're going to get back to 2% long-term interest rates. And what's very interesting about that from a equity valuation point of view, I've been struck through my career, through all the period of disinflation, as they have called it, since 1981 until recently, that the market, the PE ratio of the S&P 500 could never really get above 20 to 25 times, even in the best of markets, the strongest of markets with the lowest inflation and so forth. And that's because there was this disbelief that inflation was really in the 1 to 2% range, where it was for quite a while. Most people thought the normalized, or it's not even inflation, it's GDP growth. Normalized GDP growth is 4 to 5%, most people think, say 3%, 2 to 3% growth and 2 to 3% inflation. I just do a quick back of the envelope to try and figure out at different interest rates where the PE ratio should be. And historically, you go 1 over the interest rate. So P, this is for bonds, price, over E, earnings in the bond market. If we're at 3%, you just take the inverse of that. That's a 33 times multiple. Well, we've never gotten there. And that's because no one believed that inflation and interest rates truly were embedded in the system close to that 2 to 3% range. We do believe that, and we believe innovation is going to make sure that that's the case during the next 5 years. The only other two things I'd like to say about fixed income is high yield spreads are moving out again. Credit default swaps are moving out again after settling down, just like interest rates did. And credit default swaps are insurance policies against bankruptcies. And, it is pretty amazing to watch a company like Bed Bath & Beyond I hadn't looked at their financials in quite some time, as you probably can imagine. It's not something we would look at, but I think there might be some solvency questions there. That's why they are trying to restructure. And who would have thought Bed Bath and Beyond, sort of what we all need? Well, that's the disruption called online retail. In terms of commodity prices, just to give you some what's in the hopper here, I think I've set this up from an inflation point of view before, but the best gauge of inflation I have found over my many years in the business is gold, the gold price. The gold price has been in a trading range for the past 2 years, more than 2 years now, and it hit almost 2,100. Way back in August of 20, that's when it peaked. Made another run at it in March, failed, and any technician will tell you that's significant in terms of, okay, what is the trend here? Doesn't look like it's up. And now we're at the low end of the range, 1,700. And we think we're going to continue to break down as the dollar moves up. And we begin to see, basically an increased shortage of dollars relative to demand relative to supply, a short supply, pushing the dollar up. That's called a flight to safety, and it's happening because the rest of the world's in a bit of a mess. Europe in recession, believe it or not. You think our energy prices are bad. If you convert the natural gas prices in Europe to the equivalent of oil prices, they're almost $400 a barrel. That's more than 4 times where we are right now, almost 5 times where we are here in the United States. So that's a cruel tax, to be sure. And we do think Europe's in recession, think China's in recession. So the U.S. really is the swing factor here. On a year-over-year basis, gold prices are down 10%. Copper prices are down 21%. Lumber price had gone from $250 per unit of whatever sheath, and all the way to $1,700. Now they're back down to $486, and on a year-over-year basis, lumber prices are down. No wonder housing is in a world of hurt. Energy and food are the sticklers here. Again, Russia, Ukraine. Right now, oil prices on a year-over-year basis are up 19%. But if we stay around this level, given what happened last year to prices, we could be flat by November on a year-over-year basis. Corn today is up 24%. We know the drought and bad yields are contributing to the Ukrainian problem. We know crypto prices, they're down 60%, both Bitcoin and Ether on a year-over-year basis. And it is interesting that they're trying to stabilize in this range while other commodity prices continue to capitulate. And I'll end right now on talking about the impact of innovation on inflation. We are seeing artificial intelligence training costs dropping 60% per year. And we're seeing mind-blowing breakthroughs in artificial intelligence. So that's a huge deflationary undercurrent. And AI is going to become a part of every industry, every company. And those who harness it the most intelligently and strategically are going to be the winners. And then, with Wright's law, which says for every cumulative doubling in the number of units produced, prices associated with each technology decline at a consistent rate, that in the industrial robotics space, that rate is 51%. In the battery space, it's 28%. In the DNA sequencing space, it's 28% for short read and 40% for long read. So we're seeing deflationary forces that are beginning to matter. Electric vehicles now, it depends where you are. In China, they account for battery electric vehicles, not even including hybrid, account for 19% of all sales. In Europe, it's 10%. In the US, it's closer to 5%. So these are beginning to move the needle now. And I think we'll be shocked at how low inflation goes and how long it stays there. Now, this is good deflation. Falling prices associated with new technologies causes booms in unit growth. We're seeing that in electric vehicles now. Even though the economy is so weak, they're better, faster, cheaper, more efficient, what have you, less of a gas guzzler. So we think this is going to play out, and the surprise during the next 5 years is the deflationary undertow that we're going to be experiencing. So while Chairman Powell was, I guess, in code for Volcker in his latest speech, said, keeping at it, just like Volcker's book was titled, I'll say we're keeping at it, IT. Technology is going to permeate every sector and will transmit some deflationary undercurrents that I think are going to be quite surprising. And I think that the kind of bull market that is going to come out of this is one that investors dreamed of in the late 90s. They dreamed of it and they acted on it, and that ended badly. Today, because of what happened back then, they're running for the hills. They're running for their benchmarks. And that, I think, will end badly as well. So again, we're keeping at it. We're staying the course. Our research is pointing us in the right direction. It's the best research on innovation in the financial services world. And I think the resolution to this tug of war between 70s or not is going to accrue to equities' favor, and especially true growth stocks, those that have real revenue growth and are not manufacturing their earnings, the kinds of equities in our strategies. So I wish everyone a happy Labor Day weekend, or if you're listening to this and viewing it after Labor Day, I do hope you had a wonderful time. So thank you very much.